Hi, this is Rob Carrig with Carrig Wealth Advisors. Today is Thursday, April 3rd, 2025, and I'm going to talk through some perspective on the first quarter of the year with respect to returns in stocks and bonds, etc. And before I get into that, I do want to say that, yes, I do have a big Band-Aid on my cheek. I don't have a good story for it, so nothing to worry about. Uh, Let me jump into some slides here from our friends at JP Morgan. Okay. All of this data is as of March 31st, just a couple of days ago as I'm recording this, from the JP Morgan Asset Management Guide to the Markets. I'm going to start with this slide here. I know, as always, there's a lot in this one. I'm going to focus on this here. So year to date, so for the first quarter, you can see that large cap stocks were down 4.3%. Small cap stocks were down 9.5%. But everything else on this in this column is positive. Commodities, not a big part of our client portfolios, but developed markets, international +7, emerging markets +3, bonds +2.8. This is just for one quarter. REITs, these are traded REITs, REIT stocks, essentially, high yield bonds, cash, and what they call an asset allocation portfolio. It's down here, but it's sort of a mix of all of these things. So I would start by saying, as much as things have been volatile in stocks, particularly large cap stocks for the first quarter, it hasn't really been that bad. If we look at 2022, now, of course, this is for the whole year, that asset allocation portfolio was down about 14%, and large cap stocks were down 18. Everything in this column is down except cash and commodities for 2022. So far, it hasn't been nearly as bad. Let's see. Big perspective here that I always like to remind people of, and this is basically my entire career as a financial advisor, but let's focus on the last few years here. So this was the beginning of COVID. Stock market was down 34% in the matter of 5 weeks or so, but then went up 114%. Then in 2022 went down 25%. This is the S&P 500, and then went up 57%. That's including the recent pullback. So it was more than that. But the recent pullback in the S&P of down roughly 10% or so, that's not nothing, and nobody enjoys watching their accounts go down, but we're still far, far above where we were just at the third quarter of 2022, which is not really that long ago. Next one I want to show here is just one of our biggest holdings is the S&P 500 index fund. Just want to walk through here again some more perspective on all of this. In 2021, that was up 27%. 2022, down 19, but then the next year up 24, and last year up 23. So far this year for the first quarter, down 4.6 for the S&P 500. Again, not fun, but kind of how it goes when you're investing in stocks. And then the last, maybe the second to last slide I'm going to show here is year-to-date growth stocks, large growth stocks, down 10% for the first quarter. So not insignificant, but large value stocks plus 2.1%. So diversification has helped in this pullback. The last 10 years, growth stocks have compounded at 15.1% per year for the last 10 years. And value stocks done fine, up close to 9, but not, about half of that return. So it's nice to see that as growth stocks have taken a big hit, value stocks have generally hung in there. And then, sorry, there we go. The last slide I'm going to show is over, and I show this many times, 1950 to 2024, stocks have returned 11.6% and bonds have returned 5.2%. So why if that is the case, would we have any money in bonds if long-term they have considerably underperformed stocks? And the reason is they're way less volatile than stocks. You still have some volatility. So if you have a diversified portfolio that's a mix of all of these things, you're generally going to do better than something that is just heavily weighted in stocks or heavily weighted in US large cap growth stocks. So let me leave it there, stop share. So I hope that helps. Again, none of this is fun. A lot of this does not make any sense to me, but for the most part, people do well by just hanging in there, riding things out. If you're uneasy about this, I wouldn't be surprised. Again, no one likes to see their accounts go down, and the more money you have, a percentage pullback of, say, 5% is a bigger and bigger number. But stocks are volatile. This is kind of the way it goes. Historically, we've recovered from every other historical correction in history. I don't see any reason why this one would be any different. If we can help, please reach out. You know how to reach us. My email is rob.carrig@stewardpartners.com. And hopefully things will turn around sometime soon, and we will be not thinking about tariffs and everything else. So thank you.